I'm going to explain how reserve requirements, discount rate, open market operations, interest rate paid on reserves, quantitative easing, and Fed loan facilities affect the money supply. Let's start off with the reserve requirement. As shown in the left graph, if the reserve requirements were to increase, the money supply will decrease. If there is a decrease in the reserve requirements, the money supply will increase as shown in the right graph. The next one is the discount rate. If there is a decrease in the discount rate, the money supply will increase. And if there's an increase in the discount rate, the money supply will decrease. The next one has to do with the open market operations, which is the buying and selling bonds. If the Fed buys bonds, the reserves of the bank will increase, which will lead the federal fund rates to decrease and the money supply to increase. If the Fed decides to sell bonds, the reserves of the bank will decrease, federal fund rates will increase, and the money supply will decrease. Interest rate paid on reserves has to do with the interest rate at which banks choose to lend reserves held at the Fed to one another. If there's an increase in the interest rate of reserves, the bank will keep higher reserves. This will cause a decrease in the money multiplier, which will ultimately lead to a decrease in the money supply. The next one is the Fed loan facilities, which is to provide liquidity directly to borrowers and investors in key credit markets. In the Fed loan facilities, if the Fed loans money, this will cause an increase in the money supply, causing the savings curve to shift to the right. Quantitative and finally, quantitative easing has to do it will directly increase the supply of money by buying government securities. One example would be to buy treasury bonds, which will ultimately lead the money supply to increase.